Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
If you have pace or momentum that is coming out of a more gradual move, and it's not immediately showing you some decent follow-through on the upside, then a lot of times you're going to have to go and adjust your target levels based upon that. If you have a more gradual move, then the breakout should immediately show you strong momentum on the upside. If it's not showing you that strong momentum that is at least comparable to this previous move, then the chances are that you're not going to see a continuation move that is as strong as that previous rally. So in this case, the momentum is slower coming out of C than it was going into C. So it's not able to establish as large of a move. If the momentum had been stronger, meaning comparable or stronger than this previous upside move, then it could have hit a higher target level or a higher objective. This move marked C is not really a slower than average move in a security. It's just a faster one, it's not really a faster one than compared to a lot of previous moves, as you can see over here in the future. If you looked at previous action in the past as well, it would be about the same. But compared to this previous move A here, it is a faster move. It's still taking a lot longer to correct, however, than that previous rally took to hit these highs. So if you look at the change of price over time, it's really a much more gradual move than average. So it's able to still have the potential that this could be a strong bull flag. But since it doesn't break out strongly and show that immediate momentum right away, it doesn't follow through as easily, and it barely breaks the previous high before creating a trap and reversing. And this is something that you're going to see quite often in the overall market. This happened today in the overall market actually as well, where the futures prices were moving strongly higher this morning, and then over noon we saw the S&Ps and the Dow go for that attempt at a second high today, but they very barely broke that, just like you saw in this template. I mean, if you looked at this portion of the template here and compared it, well, actually, if you looked at the entire template today and compared it to the price action that you saw in the market today, you'll see that you had almost the exact follow-through from one setup or strategy into the next, where the pace literally moved and flowed quite like this. Heading into the afternoon, we saw a turnover in the overall market where it pulled back and then fell into a congestion zone throughout the early afternoon. Now, when you're looking at congestion zones, usually you might have a V high or a V low that kind of starts and triggers that congestion. When you have something that's forming a V bottom where there's not a change in momentum really off of the low, it's more difficult to break those previous highs. So when this pulls and drops down in here and it jumps right back, that previous level becomes a resistance level, and it's more difficult to push through that. So if you're trading reversal strategies off of a low that looks like a V or off of a high that looks like a V, it's going to be a lot more difficult to break those previous highs or break those previous lows. So that's something to keep in mind when we're looking at targets here as well. Usually you're going to see a momentum shift or some sort of other indication that can lead to a stronger breakdown before that trading range breaks. That will help give you a better idea that it's really going to confirm a breakdown in that range. You will not always get a longer base such as this. A lot of times it'll come into a low, or if this were a high, it would come into a high base here before breaking higher. So it might just pause before it breaks. But in either case, that same thing or that same idea is going to hold. In today's action, we saw that 1400 when the beige book came out is really what triggered that afternoon selling. But if you took this template and overlaid it on a chart of the Dow or the S&Ps today, this is a template that I've used for probably at least 6 years in teaching classes, and you can lay this almost directly over those charts of a 5-minute time frame and see how well they follow through. And so this gives you a good idea of just a starting point, basic understanding of pace. Here's another example of how pace can look. A little bit of a variation, same type of thing, but you can see a shift in momentum here at the highs, allows for a stronger pullback, slower overall upside move, but it's still stronger than average, pushes through slightly higher high, and then breaks lower. Now, when you're looking at retracements and looking at those levels as potential for a continuation move or for reversal moves, if you have a V or a bounce off of a low, and it only pulls up about 50% or so of that previous move, it's going to have the higher probability of forming some sort of continuation move on the downside. So when you're looking at continuation moves, something that corrects by less than 50% is going to be more ideal to create strong follow-through on that move than something that corrects more than 50%. If it corrects more than 50%, let's say you got a bounce here, and it's correcting more than 50%, then when it comes back down, even if it tries to give a breakdown, oftentimes it can trigger a false trigger and then come back up into that range. It might even go ahead and then change momentum before it turns back higher again. So this 50% level can really be helpful in identifying some of the best strategies. If you do get in on a reversal or correction where it does correct more than 50%, let's say you took a reversal off of a high up here, and it's corrected more than 50% of this previous move, then you need to be aware of the fact that that zone from that previous low is going to serve as a major support level. So in establishing targets, that's something to really pay attention to. As we go over here, I'm going to show you some examples that took place from a class that I gave back this spring, where I first introduced this concept, and we're going to look at how that action followed through, as well as give you some other additional strategies for establishing target levels and what to look for as major turning points or potential turning points in the market. When we were looking at the EUI, which is the euro-dollar, it's the currency pair represented as the option, you can see over here a good example of how momentum or pace shifted, and it allowed for this reversal off of lows. Basically, it's a little bit of a variation of a cup with handle pattern. When you're looking at a cup with handle pattern, an initial resistance level is right before that previous high is made. So here's this previous high here, and that puts a target level on a cup with handle just under it. Let's see if I can use something that's a little bit easier to draw with. And you can see that's what initially stalled the move as it was coming off of that low. Right in there, but it was able to continue and push higher just because there was larger trend exhaustion on this on the downside. But over here we were looking at pace and how it related to action that was heading into the end of the spring, going into the very start of summer this year. And you can see how pace really played a role in reversing this move off of this highs. Within this move, there was a shift in momentum where A was a very sharp, rapid upside move, B was a slower, more gradual move, and then C was even slower still.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.